Good afternoon, guys. Welcome to this new session. Very, very excited for today because we have some very special guests. So on the MenthorQ side, we have Tim. Tim works with us, and I'll let you introduce yourself, Tim, as well, for our macro coverage. And then we have Jay Midro, you've been with us for a couple of sessions. Those were awesome, so I'm glad to have you back. And then we have Brent from Santiago Capital. Welcome. Nice to have you as well. Before we go into the webinar today, we're going to talk about forex macro, about the importance of the dollar. But I would really like you guys to introduce yourself first for those who don't know you, and then we can start. Maybe we start from you, Tim, and then we go to Jay and Brent.
Yeah, sure. Welcome, ladies and gentlemen, to this little special session over here. It's a pleasure to be online with you guys here from Brent, Santiago Capital, and Jay. Highly appreciate your content since, I think, 2018 in the German, let's call it finance space. Pretty cool to see. I am with MenthorQ like around 2 years, try to covering macro topics over there and pitched you one or the other trade to the community. And from my side, I trade mostly bonds, rates, a little bit of commodities. Has changed, traded a lot. Yes, the last years, but now I'm more in the bonds and rates space, and happy to be here today. And let's hope we have a cool conversation together.
I don't know if Jay, if you wanna go next.
Sure. My name is Jay Medro. Thanks for having me again. Really appreciate the opportunity to meet you face to face, Brent, Tim. See a lot of your work online, Brent, so thank you for that. I'm happy to go into the milkshake theory with the founder today. Super excited about that. I'm ex-Lehman Brothers, Nomura, Societe Generale. It was always my dream to work on Wall Street, and I actually made it. And I traded my first 50 million bond on December 6, 2008. And then I often laugh and I say, what's the mathematical probability that I finally make it to the tier one? It was either Goldman or Lehman. And then the bank dies on me, 3.5 years. So the mathematical probability goes towards zero. And what's the mathematical probability for all of us to find each other here today during this webinar? It probably also goes towards zero, after a pandemic and now with Trump 2.0. I mean, the markets keep changing, and we have a saying at our company that is adapt or die. So it's a new market. It's very different. Sure. There's a lot of math involved these days. There's a lot of algorithms. There's feedback loops, which is why I appreciate your work, that some of the intermarket correlations you're actually putting on screen, so to speak, for the retail audience. Our job is to explain to them what they're actually looking at in a way, because at the end of the day, it's still information asymmetry. We look at a lot of data and we look at a lot of flows, and we have a lot of experience in putting that macro data together. And for me, it starts at the macro level and then down to the micro. Other people work the other way around. Super interested to hear and see how you're going about it, Brent. And looking forward to a very, very interesting conversation today. So let's go.
Sure. Well, thanks for having me, guys. I'm Brent Johnson. I've got a firm called Santiago Capital, which is a wealth management firm, and I specialize in working with individuals and families. I've been doing this for about 25 years now. I started in late '99 with a firm called Donaldson, Lufkin and Jenrette. About a year later, Credit Suisse bought us, kind of at the height of the .com boom. And so, then I was with them, through the financial crisis. Into early 2009. And I guess, I've often told people I got to where I always wanted to be and then decided I didn't like the view. I'd always dreamed of working on Wall Street, similar to you. And took me a long time to figure out how to get there, but I finally got there, and I was there for about 10 years. And, at the end of the day, I just did not want to be part of a big Wall Street firm anymore. I felt like there were a lot of conflicting interests between what was the best thing for the firm and what was the best thing for my clients. So I left there, joined a friend of mine who had his own independent firm and was there for about 10 years. And along the way, set up Santiago Capital. And so for the last 6 years, I've just been Santiago Capital, which again is a wealth management firm, focused primarily, or most of my clients are US based. I've got a handful that are in Asia and Europe. And I really take a top-down view. I'm more of a big picture guy. I'm much more likely to say buy the S&P 500 than I am to say buy, Netflix or Coca-Cola or whatever it is. It's not that we don't own individual positions, but I'm much more focused on asset classes than I am on individual positions. And I think we're in an environment where macro is going to drive everything for the next, call it 4 or 5 years. It's not that I'm not going to go on record and say fundamentals don't matter because they always matter. But I think they probably take a secondary place to kind of macro factors, at least for the next few years.
That's awesome. Yeah, thank you. Thank you for the introduction, guys. So I think we're going to go into, so the goal of this webinar is to highlight some insights on the importance of the dollar. So the question would be for you, Brent, and then maybe for Jay. So like for those who are not really familiar, can you explain first what the milkshake theory is and why is the dollar so important globally and across our economy?
Yeah, I think I'll take those in reverse if you don't mind. I mean, in really simple terms, the reason that the dollar is so important is because the dollar is what underlies the entire global economy. Now, sure, there are individual pockets where maybe the dollar is not used, but on the global stage, the dollar is the global currency. So it would be kind of like asking, Olympic swimmers, why is water so important? I mean, it's the environment in which you operate. And I think in many cases, if you were to go back over the last 50 years and you look at every crisis that happened or big drawdown, whether it's regional or global, almost all of those happen at a time when one currency is moving dramatically versus another, whether it's a short squeeze, whether it's a carry trade gone wrong, whatever it is, fiat versus fiat does matter. And it bleeds into asset prices and asset classes all around the world. So it's not that you have to focus on the dollar every day, but I think it's really hard to understand what's going on in the world if you don't at least have some idea what's going on with the dollar. So I don't think it can be ignored. And the milkshake theory really came about as a result of the fact that I thought that we were entering a time where the debts in the world had gotten to a size that was big enough that it was going to start to cause problems globally. At the same time, I thought the debts had gotten big enough that interest rates were going to start reflecting all of the debt in the world, and they would start rising rather than falling. And I thought that would have several knock-on effects. The biggest, which I thought would happen, would be a currency crisis. Now, the currency crisis did not happen, so I got that wrong. But the way the asset classes reacted to the dollar going high, and I thought the dollar would go higher as a result of all of these things. And so while the currency crisis didn't happen, the dollar did go higher. There was a lot of volatility in asset classes. Asset classes in general went the direction that I thought they would go. But we just did not have the full-on crisis. We had several mini crises and lots of periods of volatility. But so far the can has been kicked down the road, and so the world is still operating under the same system that it's been operating under for the last 50, 60 years. I think there's a lot of people that now can kind of feel or at least see that perhaps that's changing, and I think that's going to provide a lot of opportunities in the years ahead. The name came from the fact that my work suggested to me that when you enter a crisis, the dollar, for various reasons, some of them deserved, some of them undeserved, is the currency to which the rest of the world flocks, and capital will flow to the dollar. And so I said the U.S. would suck up the capital from the rest of the world. And again, if you look at asset flows and fund flows over the last 5 or 6 years, there's no question that global capital has flowed to the United States. Now, year to date, that's changed a little bit. So that's the big question: is it over? Or not? And then that's where we're at today.
Makes sense.
That's actually an interesting point that you're making, Brent, because if you look at the long-term purchase data that came out last week, we were at 259.4 billion. So that's foreign money flowing into into part of the U.S. assets that you're describing, and the data is collected by the Department of the Treasury. And this is the second highest we've ever seen the data going back to beginning of 2000. And I remember when I went to business school, they taught us that, or I left with the impression that even the central bank has a balance sheet that it can't blow up without consequences. And through the global financial crisis, I had to learn the difference between endogenous and exogenous money, right? So the way that I was taught in business school that reserves are driving credit creation is the wrong way around. And I think it was the Bank of England in 2014, they acknowledged that for the first or second time in a paper, and the Bank of International Settlements is running on that model these days. So the models have completely changed. What I was taught in business school is not how the world is running. That's why I'm so interested in your milkshake theory. What you're observing is that dollar coming back, and what the talk of the town under Trump 2.0 right now is, or some of the narrative that we're observing is that this system is changing. You know, and there's a lot of clickbait and headline pushing, the BRICS coming out with their own way of dealing in oil, and I think it is Chinese denominated currency. But it's not what we're seeing in the data yet, that this is any significant change. And in my opinion, there's various factors that speak for the dollar. And one of them being the depth and the liquidity, especially of the bond market, which is much, much larger than the equity market and more important in my opinion. And there's a picking order, a hierarchy on a trading floor, so to speak, who are the smartest people on the floor, and then it goes down. And I don't want to insult anybody, but you know, the common saying is that the bond traders are the smartest, and then after that is the derivatives traders. And equities is, and that you learn in business school as well, is the greater fool's theorem. So I'm very much a proponent of what you were saying. As long as you got some money invested in the S&P 500, you'll be doing well. It's only quite scary if you see the Magnificent Seven driving most of that growth and taking the largest share of this development currently. But I'm mixing a lot right now. I'm just saying it was interesting for me to observe that some of the models that I was taught are obviously not how the world is actually working. And maybe we can use this to elude that fact a little bit. Sure. And your the strongest straw wins, so to speak, theory is right along that alley right now. And like I said, the data is not proving yet that that system is changing. There's a lot of narrative about that, but the data is not there yet. How do you see it?
Well, so I think your last point is probably the most important thing for anyone listening to take away from this is, listen, there is a lot of narrative and there's a lot of desire for de-dollarization, for a new system, for a parallel system, for the way for the rest of the world to kind of get out from underneath the hegemonic influence of the United States. I don't deny that at all. But there's a much bigger difference between narrative and reality. And the reality is, despite all the efforts, there hasn't been a whole lot of de-dollarization going on. The second point I would make is that because of the design of the system, liquidity, money, however you want to define the dollar, euro, yen, the way liquidity is added is by adding more debt, because money is loaned into existence in our current system. And so when I bring this up, because if we were to rewind 3 years or 4 years, and we're back in late 21 or middle of 2022, and we're in the height of QE, and you know, in simplified terms, governments around the world are printing money, right? And no one more so than the Fed. But that money that's being created, that liquidity that's being created, it's being lent into existence. So while in the short term it provides liquidity and the dollar falls because there's plenty of supply, it also creates medium and long-term demand, because eventually those loans are going to come due. And when those loans come due, there's demand for the dollar to get the dollar to pay off of that credit. And that's where I think many people kind of misunderstand the direction the dollar would take if we were having true de-dollarization. And what I mean by that is de-dollarization, to get away from the dollar, to decrease demand for the dollar, that's deleveraging. You have to pay off all that debt and then move on to something else. But in a deleveraging, growth tends to slow the underlying currency tends to rise. That's what a deleveraging is, right? Now, Ray Dalio has talked about a beautiful deleveraging where it happens kind of slowly over time. I think that's about as big of a myth as central bank independence, personally. Typically, the way deleveraging happens is wild and violent, right? But that's how deleveraging happens. Is it's typically not pretty. And in that environment, the dollar would rise. It's hard to imagine a scenario where the dollar is falling and there's deleveraging. I just don't see how that happens, because the liquidity, to provide the dollar to fall increases the amount of debt. That is leveraging. It's not deleveraging. So I feel like the road to de-dollarization is the dollar going higher. And that's why I've said several times that if the dollar is going to die, and someday it will. We know this from history. Currencies don't last forever. But in my opinion, the road to de-dollarization is through a higher dollar, not through a lower dollar. So if the dollar's, the dollar's down this year, and if it continues to go lower, I don't think that's a problem. I think that's a personification or the extenuation of the current system. And it's only when the dollar goes higher that things start to break and a new system gets put in place. And we started to see shades of that in 2022. But again, they were able to kick the can down the road, and here we are 3 years later, and the system's still running.
It goes back to what Connolly said, 1971, the Treasury Secretary under Nixon, and he said, "Our dollar, your problem." And the world was shocked, but that's what you're describing in a way. If we really see the dollar strengthen to an extent where the rest of the world is crumbling under it, then maybe sorry for that, but I live in the tropics, so I don't know if you can hear the thunder or not. But you know that as well, probably, right? Puerto Rico. We have rainy season.
It's incredible how well that comment has held up, and I think it's as appropriate today as it was 50 years ago. And I don't mean to dominate the conversation here, but there's a point I want to make because I think it will help, for the rest of the discussion. Part of the reason that the dollar is so important, and this was one of the questions that was asked initially, is because the whole world uses dollars to operate on the global stage, but the whole world also uses their local currency for local business, right? The reason that's a problem, or the reason it's an issue, and the reason it comes back to your comment, our currency, your problem, is because the design of the system, and because every country has the same system, there's no other country like running a different type of system, because all money is loaned into existence, it's kind of the effect of a carry trade. You borrow money and you invest it in an enterprise or some kind of an endeavor that you think is going to make a higher return than the cost of capital, right? Well, that works great for the United States because they only have to deal with a carry trade in one currency, the US dollar, because it's both the currency they use on the global stage and the currency they use locally. But that's not the case for almost every other country. And so every other country is dealing with two carry trades at the same time. And one of them is always going against them. So what I mean by that, let's just use Europe as an example. Their banking system has a lot of US dollar credit in it, but it also has a lot of euro credit in it. And so some people have borrowed in dollars and some people have borrowed in euros. When the dollar is going up a lot, that's tough for them because now they have to service a currency that is now stronger. Because if the dollar rises 10%, now the cost of funding is now 10% higher than it was. And not only that, but the debt you have to pay off is 10% stronger. So that's going against them. We saw that very much in 2022. The flip side is kind of what we're seeing now. The dollar's down quite a bit this year, 10% this year or something like that. And as a result, because currencies are a zero-sum game, the euro's up 10%. Reuters just put out an article today talking about how Europe is struggling with the effects of a strong euro on their exports, right? So and now so now their euro carry trade is under pressure, even though the dollar carry trade has eased off. And I feel like there's this band, and I don't know exactly where the band is. Let's call it between 90 and 105 on the DXY, where it bounces back and forth in between there, and the world kind of operates okay. It's no big deal. But if the dollar gets too strong, above 105, it starts to break things. And if the dollar gets too weak, below 90, it starts to break things because the rest of the world has to deal with either a strong dollar or a strong local currency. And so that just comes back to our currency, your problem. The US doesn't have to worry about that, but every other country does.
Yeah. And the question is, what would it take for this current established system to change? And I saw a reel once, and I don't know if you guys have ever seen it, just a really short reel that had someone ask into the camera, what really backs the US dollar? And then it flipped and you saw a Navy fleet, the US fleet shipping out. And I think the military and geopolitical power is something that a lot, and I'm an ex-soldier. So before I was an investment banker, so 6 years in the US Army, 2 years in the German Army. So I was like, that's actually a very good point. And when you look at geopolitics these days and what the current administration is enforcing, willingly or not willingly, I'm not intelligent enough to make that call. I don't know if these people are playing 4D chess, as sometimes it's said, or not. But it's quite interesting that there's a lot of volatility that's being stirred up in the market. Or if we look at today's market, how subdued the volatility is while we're at all-time highs. Or yesterday making all-time highs in the S&P 500 while the VIX is rising. So again, a lot of moving shifts, bits and pieces. And when we go from macro, like you're doing, or how we are doing as well, all the way down to micro, we're using different dollar models at a given mode in time, right? So at times we look at the dollar smile, and at times the market is playing the dollar smile, Most of the time, currently not. I look at a model that Morgan Stanley developed, where you look at the real yields and the rate of change of real yields versus the rate of change of just the break-evens, right? A very, very interesting model. In our work daily, the most important thing for me personally is, do we get the direction of the dollar right? And I agree with you, we are in bands. Usually we are in a sinus curve when it comes to at least G6 to G8 currencies. And what would it take, in your opinion, also alluding and thinking about depth of market, liquidity, history, faith in the institutions, military might, what would have to happen, in your opinion, Brent, to really have this system, the current system, change? Not only, like you're alluding to, the dollar needs to break something by rising above 105 in the DXY, but is there, and that's my question, that's what I'm observing, is there an alternative system available to the world to sort of like switch over to? And I don't see that at the moment, but I'm interested in your view, or yours, Tim.
Yeah, I think, and I hate saying it, but I don't think the system changes without military conflict. I think that's ultimately where it would go. So going back to your point about the meme, what really backs the dollar, and then the cutaway to the U.S. military. Yeah, I think there is currently a little bit of a misunderstanding with that, because I don't think currently the U.S. military backs the dollar. But I would argue that if it had to, then it would. So what I mean by that is, in many ways, the market does the U.S. military's work for them. Because there's so much U.S. dollar debt in the world, because the rest of the world adopted the euro dollar as its money of choice 50 years ago, they built this euro dollar prison out of a money that they can no longer control. And it kind of got out of hand and got away from them. And so now anytime anybody tries to leave that euro dollar system, the market punishes them, either with higher cost of capital, or with sanctions, or with some kind of a currency collapse or a currency crisis. You can go around the world time and time again where someone has tried to leave the system or tried to do something their own way, and the market punishes them. But I am not going to sit here and pretend that if the U.S. had to enforce the U.S. dollar as the global reserve currency, and it chose to do so, it would do so with the military. If that's what it took, then I absolutely think that they would use the dollar, or use the military to back it up.
Yeah.
And this is where I kind of think that we're getting into this time period where my friend Michael Every calls it statecraft. I just kind of call it a unification of tools or strategies, where I don't think decisions are purely being made on economics anymore. I think in many ways, certainly for my career, which is now 25 years, and I would argue probably even for 40 or almost 50 years, for the most part, if you lived in the West and worked in developed markets, you could analyze a potential investment or an economic project based on the numbers. And if the numbers penciled out, then it would probably work out. I'm not sure that's the case anymore. Or what I mean by that is I don't think projects or treaties or endeavors will be undertaken at the national level just based on the numbers anymore. Mm-hmm. I think national interests are going to trump whether or not something pencils out on a spreadsheet. And perhaps certain things will look stupid from an economic perspective or a strategic perspective, but they may look really smart from a national interest perspective or national security perspective or an alliance perspective. And I think this aligns with Trump's, America First policy, and not just his America First policy of stuff he has control over, but he wants the State Department to have the America First, idea. He wants social programs to have America First goal. He wants, monetary policy to have America First goal. Everything he wants moving towards America First. And listen, if it works out for the rest of the world, that's great, but that's not our goal. Our goal is America First. And I think in many cases for the last, couple decades, perhaps the State Department was doing one thing, the intelligence agency was doing another thing, the military had its own views, and the Commerce Department had its own views. And I think there's this unification, centralization of power, however you want to describe that. I think that, pardon the pun, in many ways trumps everything else.
It goes all the way up to the Supreme Court right now, which, I see that development that you're describing as well. And we'll have to see how it pans out. Obviously, all of us, currently the market is not playing that it's losing trust in the U.S. system. I sometimes lose my mind trading that crap, when it's headline driven and it's like 1 minute this, 8 minutes that, then they come up with a taco trade and new nomenclatures. We love doing that crap on Wall Street. But I hear you. Interesting. Yeah.
If I can ask a question.
Yeah, let me just make one point real quick, and then because I want to make sure I say this without forgetting to say it. So I in my experience, especially because I deal with a lot of retail investors, and I go to a lot of conferences and I speak with individual investors. I don't know that it's the same way institutionally or not. My guess is that it probably is, but I don't know for sure. But when I speak to people, I speak to a lot of people who say, well, it shouldn't be this way, or this isn't the right thing to do, or this is going to hurt us in the long term. And it's not that I disagree with any of that stuff. In many cases, I agree. But I guess my point would be is I think many times people will make an investment decision based on the way they think things should be, or the way they want things to be, or the way they want their leaders to act, rather than just being, hardcore, mercenary about it and say, this is actually the way it is. This is actually what's going to happen. And I think we're going to get back into a time period, and perhaps we're already there, where power is more important than anything else. And, might makes right, so to speak. Now, again, I don't really like this. I'd be perfectly happy if we don't go back into that environment, but I just think that's where we're headed.
Well, we have a lot of moving pieces at the same time right now. We have what you're describing, and on the other hand, we have technology that's advancing so rapidly in the form of AI and significant investments into that space that will have lasting impact on us, society, humans. who knows? Unfortunately, and maybe you remember, Brent, but there was a professor, and it was like an interview years ago I saw on Real Vision, where they talked about it only occurred so many times in the history of humankind that the number 2 superpower was approaching the level of the number 1 superpower, and in most of the cases that didn't end without military conflict. I forgot what the professor's name was, or his work, or the book.
He's from Harvard. I think his name's Graham. But he wrote the Thucydides Trap. So he's a professor at Harvard. He wrote the Thucydides Trap, and it basically discusses, whenever there's a hegemon and there's a rising power, they are eventually going to come into conflict, right? Yeah. And I think, if I remember right, his conclusions were it's possible that the United States and China will not come into conflict. And I agree that it's possible, but I think it's highly improbable. I just don't see how we get away from it, quite honestly.
That's depressing, but I tend to agree, unfortunately. Yeah. And we see the market preparing for that. If you look at those equities that have outperformed those sectors significantly, unfortunately, they're all in drone space, military space. So you have that theme going on the one side, and then you have AI and energy and energy supply on the other side. Driving forces, and underlying that the dollar system, which is still the king. Dollar is still the king of the market. Fabio, you want?
Yeah. So Brent, I think we also have a lot of retail customers. So most of our users that are part of our community are retail customers. So what should the retail? So of course, retail traders do not really maybe have access to all the tools that maybe you have access to, all the research. So what are the things that retailers should be looking for when looking at the dollar, when looking at what's happening at the macro level to prepare for kind of like an asset allocation, or even like a trade ideas that they can put on based on what's happening with the dollar?
Well, so I think there's a couple really simple things that retail investors can do. And that's the first thing. The first thing I would say is, if you are not good at this, don't do it. You know what I mean? Like, if you don't have an interest or a passion for markets, and and you have to be really honest with yourself. If you have a history of not performing well on your own portfolio, then find somebody else to help you do it. I think in today's day and age, there are so many options out there, either to get consultations or to get trading advice or to get a professional money manager to help you do it. I think 20 years ago, it was much more difficult to get access to good information than it is today. But the first thing I would say is, if you're not good at it, find somebody else that is, that you trust to help you. The second thing I would say is, I am actually a believer in diversification. I feel like it's gotten popular in the last couple of years to say diversification is not important. I think Druckenmiller did an interview where he said, I'm a little different. I put all my eggs in one basket and watch that basket very closely. And I think a lot of, less than average investors heard that and say, that's what I'm going to do as well. And what I would say to you is, you're not Druckenmiller. So that probably is not going to work for you. Right. So don't have all your eggs in one basket. Don't have 80% of your net worth in one stock or whatever it is. Have a couple different bets out there, because no matter how right we think we are, we all get things wrong, right? I get things wrong all of the time. And so the key is to try to make as much money as you can when you're right and not get killed when you're wrong. But then after you have a couple of different, assets or a couple of different bets, then I try to keep it pretty simple. I look at things like sentiment. I look at things like positioning. I look at things like relative strength. I look at things like the stochastics. And when everything is at their top or at their high, then that to me at least says don't buy. You don't have to sell everything, but at least don't go double down with leverage when everything, like right now, I don't think right now would be a good time to go double down long assets with leverage. It doesn't necessarily mean there's going to be a crash. It just means the odds are against you, right? But then when the reverse comes, if we were to go back to April, all of those things I just talked about were at their lows. Positioning was wiped out. Sentiment was wiped out. Relative strength was on the floor. The world was going into a depression. Every narrative you read was, the U.S. is done. And then look what's happened over the last three months. So when everything is beaten up, then, again, you don't have to go bet everything that it's going to get better, but that's when you would start to buy. And so I use that type of stuff to tell me whether to lighten up or to maybe to get more aggressive. But other than that, I think you have to, if you look at long-term charts of asset prices, whether it's, commodities or equities or real estate, precious, they tend to go up and to the right over long periods of time. So that's for a couple of reasons. One is there's more people being born, and so there's more demand for that stuff because there's more people that are demanding that stuff. Second thing is that humans are pretty good at innovating and becoming more technologically advanced. And as we become more technologically advanced, then we become more productive, and that tends to make the asset prices rise. And one of the most important ones that we've already talked about a little bit is that, fiat currencies tend to lose value over long periods of time, right? And so for all of those reasons, you don't just want to be sitting in cash. So, you want to be invested. You want to have your money in some kind of a productive enterprise that can compound over time. So that's what, and then I would use those signals, what I talked about a little bit ago, to help smooth out the drawdowns, because there will be drawdowns. Again, if you look at those long-term charts, they go up and to the right. But you will also notice there's several scary drawdowns along the way. So if you can, try to avoid some of those drawdowns, either by taking a little bit off the table when everything gets really frothy, or buying some hedges when everything gets really frothy, that's what I try to do, is try to smooth out the big drawdowns, because everybody says they're a long-term investor until the market goes down 20%. And then all of a sudden they sell out at the bottom, because they're scared. And the last thing I would say is have some cash on the sideline. You don't need to be all in on anything. And even though having cash on the sideline is perhaps a drag on your overall portfolio, it does a couple things. It gives you some peace of mind that you don't have everything all in. Perhaps it allows you to sleep at night a little better. If we do get into one of those severe drawdowns, you're not forced to become a seller in order to get a little liquidity, because you already have some liquidity on the sidelines. And then last of all, having that liquidity on the sideline, it's actually going to help you be less panicked and more calm. And you're going to make better decisions when you're less panicked and more calm than if you're trying to do something, in the middle of a big drawdown because your portfolio was 100% invested. So I think if you use a combination of those things, I think you'll have a leg up on most others.
I think you're making some very good points, especially because there's so much exposure to retail clients. And I only had that in the last 7 or 8 years. 8 years now. So I started in 2016, and I think one misconception that a lot of retail traders have is they think, hey, I don't have money, I hate my job. I'm exaggerating, right? I'm going to learn trading because these kids on Instagram tell me how easy it is, and I'm just going to make a lot of money real quick, quit my job, and that's it. And you need to understand that the financial services industry is in the business of selling illusions. So it's our job as an exchange, for example, to come up with new products. 0 DTEs, right?
Yeah.
It's basically Las Vegas. We are creating shit to separate you from your money.
Yeah.
Okay. And in the beginning, it's one of the things when interested parties would call us or call me personally, hey, I want to go through your educational program, I would ask them something very similar that you alluded to right in the beginning, Brent. And that was like, I asked, hey, do you actually care about the non-farm payrolls? And do you know when they come out every month? Because if you don't even think about this as an easy way out for you to generate wealth, become rich, or I don't know what your intention is. If you do this full time, like you and I are doing, you need to, I call it a virus. If you're infected by this virus, unfortunately, there's no healing. You will do this for the rest of your life because it's the most complex game on earth. And that's the only reason why I do it. It's unsolvable. If it was solvable, I would get bored and move on. Yep. This is the most interesting and most complex profession on earth, in my opinion, because you always learn something new, and in the beginning, you need to understand that there's two driving factors, in my opinion. One is your brain was never constructed to trade, manage risk, right? Everything is counter to your nature, right? And I go all the way back to when we were cavemen. So your brain is not made to this. The market is the only place, like you said, where people could buy at a discount and they're not buying, right? So what works at Walmart and what works anywhere in retail doesn't work in the market. And the second thing is, so passion, and the second thing is knowledge. Learn about the different asset classes. Learn what is influencing what. Learn about how the markets are actually functioning in 2025, because they're not functioning the same way that they did in 1895 with Wyckoff and I don't know what versus today. There's so much development. Why? Because we, the industry, created new products and they all feed into each other. There's always feedback loops, right? So if you start at macro and you understand what's driving the dollar, to bring it back to the dollar, understand the difference between, so the milkshake theory is structural, but then there is also the theory of the dollar smile. And what does that mean? So I see dollar strength when there's a nuclear war, and I see dollar strength when the dollar is exceptional, right? But you see dollar weakness when the rest of the world outperforms in terms of what? In terms of growth and or the development of inflation. Know the rules of the game that you're in, and then learn about your opponents and what different tools you have at your disposal. And to think that you're going to go into some kind of like, I read one book and then I'll open an account and I trade, that's exactly what the industry wants you to do. We separate you from your money. This is so complex. It takes years and years and years and years. And then I hear crap like specialize in one thing. So in what do you want to specialize? Tell me, Bitcoin? Okay. Even Bitcoin has changed its driving forces over the last few years, and the institutional adoption is changing its character and its behavior. Sorry, didn't mean to interrupt.
I was just going to add that I think there's an additional thing I've seen it more in the last, certainly since the global financial crisis, and I noticed it becoming even more so. I actually tweeted about this last night, and I actually have firsthand experience with this. And so, what I'm going to tell you, I'm going to tell you this, not because I read it in a book, but because I went through it myself, and I made this mistake myself. And that is, after the global financial crisis, I was very mad. I was very angry. I didn't think the way the bankers were bailed out and the way the government, saved Wall Street at the expense of Main Street was fair. And I didn't think the way the monetary system worked was fair. And so I was very angry. The problem with being angry is that's an emotion. It's an addictive emotion. Once you get angry, it's kind of hard not to get angry, especially when you continue to see the injustices, or at least what you believe to be injustices. And then it can become all encompassing, and you can then start making investments based on your anger rather than being very neutral and objective about things. Not only that, but there's a lot of people now on social media, on platforms, investment platforms, who are selling you something or are selling you an idea of something based on their fear or based on their anger. They're angry at the way things are. They're angry at the way the governments are acting. They're angry at the design of the monetary system. And that anger then shows up in the investment recommendations that they make. Now, I want to be clear. I'm not saying that those investment recommendations are necessarily wrong. Perhaps they are right. I'm just saying, understand when people are telling you things that they have experience, they have emotions as well. And you have to not only control your emotions, you have to understand the emotions that the people are telling you are going through, because it is influencing their recommendations. And this is what I was trying to say earlier, is to much as you can, you have to remove your own wants and desires and feelings about things and just try to be as hardcore objective as you can. Whether you like the answer or not is irrelevant. Just try to get to the right answer.
I like what I'm hearing, and I have to laugh a little bit because, again, that's so difficult to do, right?
It's
You can
really
be
hard.
pissed
And like I
off
said,
about
I made the mistake myself for years.
I can tell you first, global financial crisis, Lehman goes, I take my box, I walk out. I had my first interview. It was with Morgan Stanley at noon. And that day it was interviews. And at 6 p.m. I had an interview with Goldman. So within days, all of us had new jobs. Why? Because even other players were upgrading. They call it upgrading. Wow, now I can get somebody from Lehman Brothers. Eventually, I signed with Nomura. Why? Because they paid me so much money. The regulator had already come up with deferred bonus. But us signing on from Lehman, we got it guaranteed in cash, no deferral. It's so unfair that it doesn't matter. Dude, you want to learn about unfair? Read about, the difference between men and women and what's really going on. Don't hate the game. It is what it is.
Well,
right?
I guess that's the point I'm going to make. If you think the game is unfair, and if you don't like the rules of the game, then don't play.
Don't play.
Find somebody else to play for you. And if you don't like the rules, I completely understand. And if you think it's not fair, then I totally agree with you. But but my point is, don't throw your money away just because you're mad.
Like this one guy did on Reddit today. He said he was betting like 27,000. His last money, he hates his job, all in right now. Either it works or he has to find a new job. That's crazy to me. But that's also, you were talking about Twitter. That's also social media these days.
Yeah.
I don't even have Twitter anymore, or whatever it's called right now. I don't, because I need to focus on my business. And my business is getting, every day the markets as right as I can possibly get them right, and trade what I see, not what I think, what I feel like, or whatever. So there's a lot of personal development and personal growth next to learning about how the game works and the math, and what's what, is also about, and that's why I love this profession, it's about growing yourself as a person, noticing your emotion. We had a saying on Lehman Brothers on the trading floor, be afraid and do it anyways. And I was like, wow, that almost sounds like, when I went to airborne school. The first time you jump out of a plane, you shit your pants, You're like, wow, but you do it anyways, right? So this market will turn you into a man or a woman because, and that's why I love it, you have to be 100% responsible for your own actions. You can be.
Yeah, I actually think people that are in the military probably have an advantage in this business over people that were not, because I was not in the military. I have great respect for anybody that is, but I feel like, the military teaches you, discipline. It teaches you how to, analyze a situation. And I probably more than anywhere else teaches you risk management, because, if you're in the military, you're facing a higher level of risk than probably anybody else.
Actually, that's very good. Can I use that in the future, Brent?
Sure. Yeah, go for it.
That's actually, and I can agree to all of what you just said. Risk management, discipline, and loving to learn. We call it the suck. It just sucks. Yeah. It sucks.
Well, not only it's also in the military. Listen, you have to be a realist. You can't say that we're going to beat those guys just because we don't like them, just because they're mean, right? You actually have to understand what their capabilities are, what their true intentions are, and how they can use those against us, or perhaps how they can't use those. But I guess my point is you have to be realistic about the other team. Whereas if you're just playing basketball or tennis and you lose, no big deal. If you misanalyze their skills, no big deal. But in the military, it's kind of a big deal.
One thing I wanted to add to what you said, because we only have 11 more minutes. You were talking about drawdowns earlier on. And there was a research piece, maybe I can send it to you. I love it. There was a research piece, and it was like, if God was a portfolio manager, sort of like that. I don't know if you've ever read it or heard about it, but they went ahead and they looked at each quarter, what were the top handful of stocks that performed in the last quarter. And then they went back and they pretended the portfolio manager, quote unquote God, was long the best performing names for that quarter. And the drawdowns of this perfect portfolio over years was, I think it was mind boggling. It was almost 40% drawdown. So again, it's a huge equity curve from the bottom left to the top right, but there's a lot of drawdowns involved. So for me, for example, very difficult to trade somebody else's model. I can't do it. I admire people who can. I cannot do it. I need to build it myself, understand it, and then implement it myself. But everybody's different, right? But I thought what you said early on, and Costolani, he was a famous investor over in Europe. He said, buy when there's blood in the streets and buy when everybody is full of fear. And here's the problem. We can say this easily into the camera.
It's really hard to do.
At that moment in time, you know what I did in 2008 when we went bankrupt? I actually got a hunting license in Germany. I bought 10,000 rounds of ammunition and guns. And I thought, okay, I'm serious, Brent. I was like, the system is failing. If people knew what nonsense the fiat system is, nonsense, right? Nonsense. Then they all would own guns. But
and that's the thing though, is like it is nonsense. It is counterintuitive. There's many things wrong with the monetary system. It is prone to failure, right? There are going to be these massive drawdowns, and yet the sun still comes up tomorrow. Markets are still going to exist, and fiat currency is going to lose value. So what are you going to do? You have to do something, right? And and listen. It's funny because on the one hand, people will, again, you got to understand, I'm dealing with a lot of retail investors, and a lot of retail investors will watch social media and YouTube, and they'll go way down the rabbit hole on these conspiracy theories
and all this stuff.
Right. And here's the thing is many of these conspiracy theories turn out to be right. And so I'm not saying don't pay attention to conspiracy theories, but there's a huge difference between imminent and inevitable. And I don't remember who, I think Rick Rule is the first person I heard say that, and I probably didn't quite understand it when they first said it, but it's true. Like something can be really messed up, but it can be really messed up for a really long time before any consequences happen as a result of it. I mean, if you went through the global financial crisis and you saw the inner workings of what was happening, and somebody told you 15 years from now, asset prices will be 3 times as high and the debt will be 4 times as high, you'd say, no way, it can't go on that long. But here we are, right? And so, they said the same thing in COVID. That was 5 years ago, but here we are. And so I know there's a lot of people probably out there listening right now saying this cannot go on any longer. Well, I'm sitting here telling you it can go on longer, and I think it will go on longer. You have to be ready for it to go down tomorrow, but you also have to be prepared for it to last another 5 or 10 years. And you kind of have to strip out your emotions to do that. But again, that's, I know I've used the word emotions several times, and it's true. Like your emotions will screw you in this business or in this endeavor. And I'm telling you this because I know it, and I've been doing it for 25 years, and I still have to work on it because that will get you more than anything else.
Yeah. And you have to have some sort of understanding of be afraid and do it anyways. You have to go through it yourself, Find some setup, some situation, and this is something that we actually teach, where when the markets drop, have a sequence of events, what you want to see, 1, 2, 3, 4, now it can buy the bottom. It's a little bit to what you probably have as well. You were alluding to 1 or 2 points that you're looking at, and this is now, you're going to be scared shitless, you don't want to do it, but you do it. And the way to do it, in my opinion, is to start in the beginning, and that is know how much money is coming in every month and how much are you spending. That's the first thing most retail traders don't have. The second thing is know that at least until today, July 22nd, 2025, the US has the only super mature equity market in the world that is outperforming and has generated 8.5% yield annually since its inception. So there's no other equity market on earth that is as mature, as liquid, and as advanced and data-driven as the US. So know that, and then go ahead and do dollar cost averaging, invest in the S&P 500. If you have those 2 bases covered, then now let's talk about different asset classes. Yeah. What season is it right now in the market? In the summertime, you want to be summertime, quote unquote, you want to be long equities. In the wintertime, you want to be long bonds. Understand what the central banks are doing, the difference between a business cycle and a credit cycle, and so on and so forth. And then you're going to love it. You're going to love it because you'll have money that is compounding slowly. The theorem of the greater fool's theorem in the equity market. Yet it's true. I agree with you. Equities are dynamic because companies are dynamic and because we are growing. As humans, we are growing. So if you invest in an index will always end up, as a 45-degree line. There's drawdowns and there's exuberance, but it has survivorship bias. And a lot of people don't even know that. So they're going to NVIDIA until one day, and I'm just making this up, but I've seen this with a lot of companies, take Lehman, until one day that stock doesn't exist anymore. Well, it's just going to get replaced in the index. So save in the index and then get more involved, in my opinion, in either a sector or an individual name if you want later. But also understand if it's winter time in the market, i.e. bond time, and you're looking at Tesla equity, why not look at Tesla bonds at that moment in time? So you can go deeper if you want, or get somebody like you to do it for them.
Yeah. Well, I think one of the last points I'll make here is part of the reason I focus on the dollar is not because that's my investment. I'm not sitting in dollars. That's never been the recommendations for everybody to just go sit in dollars. Now, I think everybody should have cash, and I think that cash should be in US dollars versus some other currency. But the recommendation has never been to just sit in dollars. But the reason I focus on the dollar is because every financial crisis of the last 50 years has coincided with a rising dollar versus other currencies. Now, that's not guaranteed to happen in the future. Can it be different in the future? Sure, it can be. It just hasn't been. And I think it's unlikely to be next time. And so I think it's really hard to get everything else in your portfolio right if you get the dollar completely wrong. And it doesn't mean you have to be 100% right about the dollar, but you just have to understand why it's doing what it's doing, because it does underline everything. So it's a form of risk management. And the other thing I would say, and the reason I keep coming back to the dollar will outperform other currencies, is not because the dollar is a good currency. It's a horrible currency. It's just better. It's just better than all the others. And part of the reason the dollar is a superior currency to the others is because all of the others are backed to a certain extent by the dollar. And what I mean by that is every central bank in the world holds U.S. treasuries on their balance sheet. Every bank in the world holds U.S. treasuries on their balance sheet. If U.S. treasuries go no bid and the yield spikes and the price falls, is that bad for the United States? Of course it's bad for the United States. But every bank in the world goes under that scenario. Every central bank is now impaired under that scenario. So it's not uniquely bad for the United States in that scenario. It's bad for everybody. And that was actually the genesis of the milkshake theory, was that I thought we were at a point where interest rates were going to start to rise. I don't think treasuries are going to go no bid, but I thought prices were going to come down. And not only that, but when yields rise, when U.S. Treasury yields rise, is it bad for the U.S.? Yes, it's bad for the U.S., but it's a nightmare for any emerging market country or company that's trying to raise money, because now they have to compete with the U.S. Treasury. So if a U.S. Treasury is yielding 5 or 6%, what do you think a Brazilian corporate has to offer, or a Turkish corporate has to offer? That means their funding costs have just gone up as well. So in that scenario, I come back to the world. There's 4 things that I think can happen. Maybe everything gets better. Maybe we find some new technology, some new innovation comes out, the world becomes more productive, and we all grow out of this. In which case, I'm happy to be invested in the United States. Perhaps the whole world goes down together. Perhaps this mess is not solvable, and we're going to go down. In which case, the U.S. goes down, but the rest of the world goes down too. Might as well just be in the U.S. The third thing that could happen is maybe the U.S. continues to chug along, does okay, and the rest of the world has problems. We've seen that many, many, many times. And the fourth thing that could happen is the rest of the world gets better and the U.S. falls, right? Now, out of 3 of those 4 scenarios, I would prefer to be in the U.S. than, somewhere else. And it's only in that last scenario where I'd prefer to be outside the United States. But the probability of that last one happening, based on what I just told you about the whole world owning U.S. treasuries, right? I think that last possibility of the U.S. doing really bad and the rest of the world doing really well is a very low probability event. Now, it's not zero, so I have to consider it, but it's a low probability event. And so that's a pretty simplistic analysis, but just based on that, keeping it simple, I want to have the majority of my assets in the United States as opposed to abroad.
Yeah.
And it goes exactly back to what we said in the beginning, the tick data from last week. Yeah, it's a difference. Long-term purchases by US versus long-term purchases of debt by foreigners. Second highest reading since 2004, basically the same reading as May 2021, outside of 1 billion. So there's money flowing into long-term US debt. Why? Because we're at yield levels that are attractive compared to the rest of the world. And what you can take from this as the audience is you see a very strong dollar. You want to short emerging markets. You see a weak dollar. You want to look for long opportunities in the US market. It goes back to your carry trade, but not everybody knows what a carry trade is.
Yeah.
It's important to have that on the radar. Get the dollar right. You have opportunities that make money. Always. And stop wasting your time on, okay, if I'm now going to buy whatever SDRs by the World Bank because the dollar is going under. No, that's not happening tomorrow. Yeah. There's a very low probability that the world ends. It gets you a lot of clickbait, lots of views on social media. But if you as a retail trader or investor invests in that portfolio, in that situation, there's a low probability. A higher probability is that the world will continue for the next X years. We don't know what's going to happen. And you just do business as usual and compound wealth. That's your job. Create wealth, protect wealth, and compound wealth, basically.
All right, guys. So I think this was awesome. I think I know you have 60 minutes, Jay and Brent. So I don't mean to cut it off, but I think this was an awesome session, and I really appreciate your time. Jay, as always, we love having you here. I love your approach, and I love your knowledge that you bring. And Brent, it's great to have you here. And I think what you said at the end was really simplifying to the max, but that's exactly how a retail trader should look at the world. Basically, like when you allocate, what are your best probability of success, and then based on that, allocate accordingly. And thank you, Tim, for being here as always. But yeah, really appreciate you guys, and see you soon in the next sessions.
Thank you.
Thanks for having me.
All right, guys. Thanks.
See you later. Ciao.
Ciao.